Hi, welcome. This is the first of three sessions that I've done on value investing, and I know you don't have much time on your hands, but if you do, I'd like you to watch all three sessions put together. In this first session, I want to talk about the legend of value investing. Why do value investors think that they're on top of the heap? What is it that drives their sense of superiority? So I'm going to look at history, I'm going to look at the backing for value investing. In the second session, I'm going to look at the dark side of value investing. Even in the glory days, I'm going to argue value investing was never as good as it was made out to be. In the last 10 years, the bottom seems to have fallen out of value investing. And we're going to talk a little bit about why, because finding the right reason for it is going to give you the right solution to it. And in the third session, I want to talk a little bit about where value investing needs to go next. These are all very personal views, and I'm sure you will disagree with me on them, but I hope it'll get you thinking. So let's get the process started. Let's start with why value investing thinks of itself as the top of the heap. Now, I teach a class in investment philosophies. What's an investment philosophy? It's a way of thinking about investing. It starts with a belief about how markets work and don't work. And from that, you come up with a philosophy about how to invest in markets. And when I teach that class, I go through the whole range of investment philosophies with no judgment passed. I start actually with technical analysis and charting. Investors who invest based on momentum, who value investors might look down on, so I start with that. Then I look at value investing. Then I look at growth investing, its ugly cousin. Then I look at market timing and arbitrage and basically every conceivable investment philosophy. And when I describe these philosophies, the one group that I get pushback on from is value investors. They say, why are you wasting your time on all of those investment philosophies when we know what works? It is value investing. So in this session, I'd like to dig a little deeper as to what it is about value investing that leads to this sense of superiority, whether it's justified, and perhaps whether changes need to be made about the way we think about value investing. So there are three questions I need to answer in this process. First is, what exactly is value investing? In fact, we'll see that even within value investors, there's no consensus about what comprises value investing or who a value investor is. And second, within value investing, I'm going to argue there are very different strands of value investing that bring very different beliefs about markets to the game. Second, I want to talk about where is it that that value investors get the certitude that they're going to be the winners in the long term. And third, I want to talk about how long is long term. Do I have to wait 5 years, 10 years, 20 years? Is there something in the data I can use to answer those questions? So let's start with what value investing is. If you think about categorizing value investing, if you go to Morningstar or you go to S&P and you look at how they categorize value investing, it's an extraordinarily lazy categorization. In fact, the view that many services use when it comes to value investing versus growth investing is if you buy stocks that have low PE ratios, you must be a value investor, whereas if you buy stocks with high PE ratios or high price to book ratios, you must be a growth investor. I know if you're a true value investor saying that's not the way I think about myself, but most service categorizations of value investing are based on the multiples that you pay for stocks. It is true that if you ended up in Omaha during the Berkshire Hathaway meetings and you talk to some value investors, and many value investors I respect who've thought through this process, their view of value investing is a little more cerebral. It's not just PE ratios and price to book. It is true that even these cerebral value investors start with a measure of cheapness, low PE, low price to book. But they say we look at other things. What other things? Good management, big moats. And if you look at the literature on cerebral value investing, they've listed out variables they look for, some quantitative, some qualitative. And in the last 20 years, there's a third way in which value investors have described themselves or categorized themselves. I call these value investors big data value investors. They again start with the premise that buying low PE or low price to book stocks is good, but they look for other characteristics to add on to make these stocks good investments. What are the characteristics? They allow the data to drive them. So if the data tells them that high quality stocks, low standard deviation stocks are going to deliver returns, they view that as something they should add on to looking at PE ratios and price to book ratios. Lazy value investing, cerebral value investing, big data driven value investing. Now, there's a different way in which you can also think about value investing based on how investors approach value investing. And this is a way that I used in my investment philosophies book to break down value investors. The first group of these value investors I call passive value investors. What do? They screen for stocks that will be bargains. If any of you have read Ben Graham's Intelligent Investor or even browsed through it, in one of his very early editions, he listed out 10 or 11 or 12 screens he said would lead you towards finding cheap stocks. It's passive because you're really just running these screens across big data sets and finding companies that come through. That's passive value investing. You buy those stocks and then you sit back and wait. The second group of value investing I call contrarian value investing. What do you do here? You look for stocks that have had big drops in stock prices, 30, 40, 50%, and you buy those stocks. Implicitly you're saying when you see a big drop in stock prices, it's usually a market overreaction. It doesn't always have to be, but it's usually a market overreaction. And that if you buy these stocks, you're going to gain from the recovery. The third is what I call activist value investing. What do activist value investors do? They target not necessarily cheap companies, but badly managed companies. It's even better if it's badly managed and cheap. And then they push for change. Change in what? Pretty much everything. How the companies invest, how they finance, how much cash they return. Activist value investors is driven by big names, Carl Icahn, Bill Ackman. So these are groups that basically are investors who push for change and they hope to make money from that change. And finally, there is a last category that I call minimalist value investing. What do these investors do? They start with the premise that diversification is a good thing, and index funds have actually been a contribution to investing. In a typical index fund, let's say the S&P 500 index fund, you basically buy every company in the index in proportion to its market cap. What minimalist value investors do is they take those index funds and they tilt them. Tilt them in what sense? Rather than weighting companies based on market cap, they might weight them based on PE ratios, basically tilting the fund more towards low PE ratio stocks or high dividend paying stocks. Do you see why it's minimalist? Because you're starting with a pretty diversified portfolio and altering it a little bit to capture what you think will be additional returns. Those additional returns might not be much, but given that you have pretty close to an index fund, they might be sufficient. Now, you might wonder, what do these different groups of value investors all share in common? And I do think they do share something in common. While they might approach investing in very different ways and with very different motives, here's the common thread that runs through all of value investing. And to understand this common thread, I'm going to draw on a structure you've seen me use before, a financial balance sheet, where I break down a company's value as coming from investments it's already made, assets in place, and investments it'll make in the future, growth assets. And if you look at that breakdown, here's the way to think about it. Mature companies get the bulk of their value from assets in place. Growth companies get the bulk of their value from growth assets. So if you were comparing Lyft to Levi Strauss, an established mature company, gets a bulk of its value from assets in place, but Lyft gets a bulk of its value from growth assets. You're saying, what's this got to do with value investing? Value investing at its core believes that when markets make mistakes, they're more likely to make them in assets in place, investments you've already made, and that your chance to make money therefore comes from focusing on companies that get the bulk of their value from assets in place. You're making a bet that you're better at assessing the value of assets in place than the market is. You know what growth investors do? They care about value too. If you think Peter Lynch did not care about value, you're barking up the wrong tree. But here's how they approach investing differently. They believe that markets are more likely to make mistakes on growth assets because there's a lot of uncertainty, and that if you're a little better at assessing the value of growth assets, then you will make money by buying growth companies that are undervalued. In fact, it muddies the waters on growth versus value because it says everybody cares about value. The question is, what component of value are you playing with? Value investors play with assets in place. Growth investors play on growth assets. So with that set up, let's think about where the roots of the value investing win story comes from. Well, some of the roots are story roots. And to understand the beginnings of value investing, we have to go back 100 years. If you go back 100 years, equity markets were nascent. They were young and they followed bond markets. In fact, many investors coming into stock markets had learned their lessons in bond markets. So when they came into stock markets, they looked for things that they were familiar with from the bond market. There was very little information disclosure, and investors basically bought stocks with high dividends because those look like coupons. So for a century ago, if you asked me, how did people invest? They invested in stocks as if they were glorified bonds. Ben Graham, in many ways, laid the foundations for value investing after the Great Depression. His book, Security Analysis, the first edition of which came out in 1934, formalized a way of thinking about investing that was different. He said, you know what? I can find bargains in stocks with thorough research. In fact, the words he used were one with thorough analysis, you can find investments that are both safe and deliver a return. Notice safety comes first. Ben Graham viewed stocks through the prism of bonds. So his view was let's collect the cash flows, and if you have safe assets, even better, you get icing on the cake. He subsequently wrote The Intelligent Investor, a less complex version of security analysis. You're not so much in the depths, but a more philosophical treatise on how to invest. In 1938, John Burr Williams wrote the book Theory of Investment Value, where he introduced the notion of present value, the foundations of discounted cash flow valuation. So value investing has its roots in Ben Graham and John Burr Williams. But if you look at how these stories evolved, value investing's oomph, the mojo came essentially from Ben Graham, not as an investor but as a teacher. Ben Graham taught his way of investing at Columbia University. And one of his most famous students, perhaps his most famous student, was Warren Buffett. And nobody has advanced the place of value investing more than Warren Buffett has. Because here's what Warren Buffett did. He took what he learned from Ben Graham. He put his own tweaks on it. And as we will see in a couple of minutes, while Graham was very much focused on looking at financials and screening for companies, Buffett was more willing to look for qualitative factors when he invested in companies. Warren Buffett created a partnership to invest in companies. And that partnership did pretty well. So it was a surprise in 1969 when Warren Buffett dissolved that partnership. And I think the Buffett legend comes partly from the letter he sent to his partners when he dissolved a partnership. Remember, when you dissolve a partnership, you're giving up an income stream. Who does that, right? He actually said, when he dissolved the partnership, said that he was being given a choice because stocks had gone up so much between staying true to his investment philosophy or finding investments and making money. And he said, look, I'm not going to bend my investment philosophy. I'm going to dissolve the partnership. Once he dissolved the partnership, he gave investors a chance to reinvest with them in a company called Berkshire Hathaway, which was a struggling textile maker, which he used to essentially create a front for his next round of investing. Because Berkshire Hathaway took a piece of Geico, which is an insurance company, and over time, Berkshire Hathaway really became an insurance company with a closed-end mutual fund. Let me be very clear. The reason I describe it as such is as you follow Berkshire Hathaway over time, the shirt company is long since gone, even though they preserve the name. It's Geico that's delivering the capital. And why is it delivering the capital? Because insurance companies collect premiums, and those premiums get invested. In most insurance companies, those premiums get invested by pretty average investors, but Berkshire Hathaway had the most famous value investor of all pick stocks for it. So when you look at Berkshire Hathaway's balance sheet, you see Geico, the insurance company, delivering capital, and Warren Buffett's investments essentially giving that closed-end mutual fund the drive of picking great investments. Now, anybody who's invested in Berkshire Hathaway has no reason to complain. Because take a look at how well the stock has done going back to its inception. So if you invested in Berkshire Hathaway, and let's say you invested $100 with Berkshire Hathaway, look at how much money you would have today. You can see why the legend of Ben Graham has grown over time. So when you look at the roots of value investing, you can go all the way back to Ben Graham and then at Warren Buffett, but it's a success of Berkshire Hathaway and what Warren Buffett has contributed that's made value investing what it is today. So that's the story route. And if you look at the story route, the stories about Warren Buffett's success actually are just as important as the numbers. So anybody who's tracked Warren Buffett knows about his investment in American Express in the early 60s. American Express, then a credit card company, had a problem. It had what's called a salad oil scandal. It invested in an Italian company that produced salad oils that turned out to poison people. And American Express's stock price dropped. And as legend has it, Warren Buffett looked at American Express and he said, there's a core franchise here that's worth 3, 4, 5 times what the stock price is. He bought the stock and he made money. But that story remains. One of the reasons value investing has so much resonance is you have stories like the American Express story that gets told and retold. And of course, with 50 years of annual meetings in Omaha with Berkshire Hathaway, those stories have acquired these rounded, perfect edges. So those are the story roots. If you just start with the story roots, value investing wouldn't be as powerful as it is today. Along the way, value investing also acquired numbers roots. And it's ironic that these numbers roots for value investing came from the very academics that value investing has so much contempt for. Let me step back and explain what I mean by this. In 1964, in academic finance, modern portfolio theory, you had the capital asset pricing model developed. The capital asset pricing model, there is only one number you need to explain differences in returns across stocks, which is betas. So once the CAPM, or the capital asset pricing model, was derived and presented, for the next 15 years, academics tried to test the model. Initially, the premise was markets are efficient, the model should work, but the more they tested it, the more they found places that the model did not work. Hang in there, this is leading somewhere. In 1981, Rolf Benz published one of the most famous papers in finance, where he showed that small cap stocks consistently earned higher returns than the CAPM. And as you go through the 80s, building into the 90s, people started to find that buying high dividend yield stocks, or low PE stocks, delivered returns higher than the CAPM. And then came Fama-French. Gene Fama and Ken French, the University of Chicago in 91, basically wrote, again, an extraordinarily influential paper where they look back at stock returns from 1962 through 1990. And here's all they did. They first checked to see how much of the returns CAPM betas explained. They said that they don't explain much. And then they started to look for other variables that explain returns. And they found, for instance, that low price to book stocks earn significantly higher returns than high price to book stocks. You see how this burnishes the value investing legend, because one of Ben Graham's creeds was to buy stocks with low price to book. And here you have academic backing for that proposition. In this graph, I've actually updated the Fama-French study, which went through 1990 all the way through 2019. And you can see the roots of what they found. Low price to book stocks have earned significantly higher returns than high price to book stocks. Low price earning stocks have earned higher returns than high price earning stocks. High dividend yield stocks have earned higher returns than low dividend yield stocks. Now, we have to be very careful, because Gene Fama and Ken French, when they found this, did not argue that value investing works and you should buy low price to book stocks. In fact, I think one of the things that's been blurred in this research is that within academia, there's a very strong disagreement. There are some who look at what Fama and French found, and including Fama and French, who argue that what these studies show is the limitations of risk and return models, that we're not measuring risk right. In fact, Gene Fama has argued that price to book ratios, low price to book ratios, might be proxying for high risk companies. You're saying why? Maybe companies with the price is low relative book value have higher distress risk. But you could make an argument that what these studies show is not that low price to book stocks earn higher returns, but that risk measures are imperfect. That's one way to read the data. The other way is to argue that maybe this is a sign of market inefficiency and you can exploit it by buying low PE and low price to book stocks. Not surprisingly, value investors have latched on to the second reading. But the end result is value investing, at least coming into this century, came in with the best of combinations. You had all these stories going back all the way to Ben Graham about how value investors won, told and retold and accumulating, added layers of detail across time as the stories get retold. And numbers coming in from academics backing those stories. I've described valuation as a bridge between stories and numbers. And I'm going to make the same argument here. Value investing as a philosophy has the strongest connection of stories and numbers backing it up. And that's why it has so much resonance. What I mean by so much resonance is most investors, if they're asked to describe themselves, almost reflexively describe themselves as value investors because it sounds like the right thing to say. So it is clear that value investing came in with a strong hand into the century. And that strong hand came from both the stories about value investing and the numbers. And that is the next, and that is what I want to come back and examine a little more closely in the next session. I hope you found the session useful, and thank you very much for listening.